And I think that the situation that we have at the moment persists.
Hey, Julian, thank you. Julian Lee there, the latest on the commodity market alongside Anne-Marie Hordern down in DC. So, the gas story improves. Gasoline prices have come down. And because retail sales are a dollar figure, it is a dollar story, a nominal story. You have to kind of strip gas out to get a decent read, a better read of underlying demand in the economy for the US consumer. Ex-gas and autos, US retail sales were pretty decent this morning, so that adds to the move at the front end of the yield curve. Yields up 9 basis points on a 2-year, 335. Yields up, stocks down. The Nasdaq down by about 1 full percentage point. The S&P down by 0.75%. We will get you the trading diary in just a moment. That's next. Snapping a 3-day winning streak on the S&P. We're down 0.7% on the S&P 500. That's the price action. Here's the trading diary. The latest Fed minutes, 2 Eastern. A host of Fed speak coming up with Governor Bowman at 2:30. Then Esther George and Neil Kashkari on Thursday. Retail earnings continue to roll in. Coles and Ross reporting, followed by existing home sales and another round of jobless claims. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the start of the U.S. trading day, and this is Wednesday, August 17th. These are the top stories we're watching for you this hour. U.S. stocks are in the red as retail sales stay flat for the month of July. And is the health of the consumer worse than the numbers even show? We'll discuss. Plus, from stores to stocks, why retail traders are pouring into names like GameStop and Bed Bath & Beyond. We'll discuss it with an exclusive interview with the founder of Reddit's Wall Street Bets. And we'll get the latest in Washington as Liz Cheney loses the primary election and traders prepare to parse through the latest FOMC minutes. From New York, I'm Shonali Basak with Guy Johnson in London. Alex Steele's off today. Welcome to Bloomberg Markets. Guy, how do we think about these retail numbers? They are flatter than expected, and there is more still to come on the inflation front.
Absolutely. But the sense, certainly if you strip out gas and autos, Shonali, is that we are seeing actually these numbers holding up relatively well, which is confusing me. I am confused by just about everything right now. I'm confused as to why we're back talking about meme stocks. We'll talk about that a little bit later on. But in some ways it does combine with the shopping story with Bed Bath & Beyond. And I'm confused that the consumer is holding up in the way that the consumer is right now, still spending, maybe trading down a bit, but still spending quite a lot of money despite this squeeze on income. So I'm a little confused. Have you got a handle? You're way smarter than me. Have you got a handle on what is happening here?
How about you be the bull today? I'll be the bear. I also don't have a full handle on what's happening today, but I will say with Bloomberg Intelligence expecting inflation at 7.5%, are meme traders buying stocks on credit at this point? Guy, it's anyone's guess.
Yep, on margin, on credit, it certainly seems to be some evidence of that. So that comes to our question of the day, which the team put together a little bit earlier on. Bed Bath & Beyond your means. Are the consumer spending beyond their means? Is the consumer spending beyond its means? And are maybe the meme traders doing the same thing as well? Let's try and kick that question around. Let's try and get to an answer as we pass through this data. Bloomberg's international economics and policy correspondent, Mike McKee, over in New York. Andrea Felsted, Bloomberg opinion columnist covering consumer goods and retail, joining me here in London. So as Andrea's here in London, I'm going to start with her. Andrea, I am confused. The consumer is holding up. There are headwinds after headwinds battering the consumer, yet here we are.
You're not the only one confused. Right across the earnings season, we have been getting clues that the consumer, particularly the low-end consumer, is feeling some distress. We're also seeing that go slightly up the income scale. We had Walmart talking yesterday about wealthier families shopping in Walmart. Now, the other factor is, as you mentioned, gasoline is coming down slightly, inflation's easing. They have also talked about the picture being slightly brighter lately. Back to school, often a good indicator of how the winter holidays are going to be, has been encouraging.
Okay.
So, Mike, we have you down in D.C. also. When you look at the retail sales that have come out today, how is the Fed likely to look at what's happening here? Is it good news or is it bad news, given that some flatness is not a bad thing when they're tightening?
Well, it does suggest the consumer is hanging in there. Now, the mix of what was bought and where it was bought is a little discouraging in the sense that almost all of the retail sales came in non-store retailers, which is essentially probably due to Amazon's Prime Day in July. And then when you adjust for inflation, retail sales were actually down. So it isn't as good a news as it appears, but overall, consumers are still hanging in there. Now, the one thing about what Andrea said is that in the U.S., general merchandise stores, department stores, clothing stores, the back-to-school store kind of experience, they were down all in the month, even without adjusting for inflation. So it'll be interesting to see where Americans spent their money. For that, we have to wait for the PCE report. It comes out a week from Friday, which is Jackson Hole Day.
Yep, really looking forward to that. Some great coverage coming up from you and the rest of the team. I apologise, you're in DC today. There's a lot of things going on down there. Mike, let's talk about where we are with the consumer and credit. Michael Burry was out with an interesting tweet a couple of days ago from Scion. Net consumer credit balances are rising at record rates. Consumers choose violence rather than cut back on spending in the face of inflation. Remember the savings glut problem? Question mark. No more COVID helicopter cash. Taught people to spend again, and it's addictive. Winter is coming. That was the whole quote, Mike. The point of it is that he thinks that the consumer is spending on credit right now, and there's certain data that maybe backs that up, and we still don't know what the buy now, pay later stuff looks like either. So what are we seeing on credit? Are we running on fumes here, or is this the consumer still spending kind of COVID reserves that have been built up over the last couple of years?
Well, it's a little bit of both. Now, the people at the lower income scales who would be patronizing the retailers that have reported this week, they've run out of much of their COVID stimulus money. So yes, they're probably buying on credit and or buy now, pay later. People with a little bit more money, the savings rate is still relatively high. The amount in savings is still relatively high. So there is some leeway there. We're not really sure how that spending is going at this point. It'll take a few months to get a real handle on it, but it looks like both. Now, the important thing so far is that the debt-to-income ratio has not risen significantly. People may be using more credit, but they've been able to pay for it. We'll keep an eye on that to see if people are getting overextended.
Overextended, and Andrea, this comes as the cost of credit is rising. So if you take a look at consumer credit balances rising, according to some Federal Reserve data earlier this month, they're going to be paying more for that credit soon. Is that likely to eat into spending moving forward, given it will be more expensive for them to do what they did this time around and buy on their credit card?
That's definitely a possibility. I mean, higher borrowing costs are another factor in this whole consumer equation, whether the consumer is going to rein in their spending.
In terms of how this has worked in the past, is there a historical guide? When we've gone into periods where interest rates have risen, have consumers cut back? I appreciate that we haven't been in that kind of period for a very, very long time. Is the consumer used to rising interest rates? Is this something that we've had as a generational kind of experience, been able to sort of have some history with?
Definitely not. I mean, over recent years, borrowing costs haven't really been a factor. What's been a bigger factor is the squeeze on income from inflation and wages, which we saw around 10 years ago.
Yep.
And at that point, the consumer really retrenched. And certainly in Britain, that is what a lot of retail executives are expecting for the autumn.
Mike, let's give you the final word here because, again, you're down in Washington and there's a lot of news coming out. You'll be in Jackson Hole before we know it. How is the Fed likely to look at the data that is coming out today, that is coming out in the coming weeks, and making decisions that might surprise the market in some regard?
Well, I think the idea is not to surprise the market, which is why it wouldn't surprise me if Jay Powell came out and pushed back against the narrative that we've seen lately in the markets that the Fed is going to raise rates a little more and then start cutting rates early next year. They're going to be on hold because the data are so mixed. We had a very strong payrolls report. We had inflation come down a little bit in the CPI and PPI. Retail sales aren't as good as they look on the surface, but they do suggest the consumer's hanging in. Home sales have dropped off a cliff. So some good, some bad. The Fed's going to want to have a better handle on where we are, particularly with inflation, before they send any signals about what they're going to do.
Some good, some bad. That's why we're so confused over here still. Bloomberg's Mike McKee, thank you so much for your time. And Andrea Falstad, Bloomberg opinion columnist. Coming up, investors are being urged to look at companies with better balance sheets and strong cash flows. That comes from Sarah Hunt, a portfolio manager at Alpine Woods. We're going to talk with her next. This is Bloomberg.
This month, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg Surveillance is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th, only on Bloomberg Television and Radio.
Every single company is talked about the fact that whether it was from late May or early June till mid-July, there are pressure points. The consumer stopped spending. That consumer who basically is below $100,000 income was pressured by rising gas prices. What I'm still hearing from retailers is there's still a mismatch, and we're still going to have certainly more goods available in September or October for these off-pricers to benefit from.
That was Dana Telsey weighing in on the state of the consumer and retailers earlier, which takes us back to our question of the day on just how healthy the consumer actually is. So Bed Bath & Beyond your means? Let's ask Sarah Hunt, Alpine Woods portfolio manager. Sarah, if you take a look at Walmart, there was so much optimism there, and then you take a look at the retailers that reported today, Target, others, not so rosy. So is the spending that we're seeing healthy spending, or are there more issues in the road ahead to come?
I think that you do have a consumer that is that is under a lot of pressure, especially on the lower end. I think you're seeing that trade down. I think you're also seeing people looking to spend. I mean, it was interesting to see Home Depot's numbers and how well that stock reacted to sort of flat, but also not as bad as people thought it could be. I think there's going to be some issues going forward because we do have a problem on the income side is not raising as fast as prices are. And I think that right now we've still been able to get through earnings with pretty good numbers across the board, but I wonder how much some of that inventory coming in is at a higher price point, and therefore it's going to be tougher to see that do as well in the next 6 months.
Okay, but where we are now, you've got a consumer that's holding in there, you've got a stock market that is rising, you've got a belief that inflation probably may have already peaked. Sarah, does the rally make sense to you?
I think some of the rally made sense. I think we were very oversold when we hit the lows in late June. I think some of the speed of this and some of the, I would go back and say maybe some complacency on the inflation front. Oil prices have come down, but why have they come down? They've come down partially because we had demand destruction and partially because China is still very slow. Other commodity prices have come down for the same reason. The earnings picture that we're looking to be better again in 2023 versus 2022, it takes into account some of those higher commodity prices. So there's going to be some potential pressure on the earnings front, and that fall off in oil prices was really not because we got a better supply picture or we got something else. We just got a less demand picture, and I'm not sure that that's going to fold into the inflation story the way that people want it to say that, yes, that was absolutely peak inflation.
You know, you can't get too excited about consumer discretionary being down more than 16% on the year, Sarah, but it has led a lot of the more recent rebound. Given what you're saying about the trade downs and the other issues that still exist among the consumer, can we rely on a sector like that to carry us through the year still?
I think that's going to be a little bit tough. I think that's going to be tricky. And I think that if you think about the sectors that you want to rely on, I mean, right now the quality trade hasn't done as well as a factor than some of the other things. But I think that really we're going to get back to balance sheets and cash flow again. And I think that the consumer is in reasonably good shape, but you look at where housing is, you look at how high rents are, I don't see that those prices are easy to bring down in the same way that a drop-off in demand for oil has brought oil prices down. So I'm not sure how fast you can get that inflation picture to be as rosy as the Fed wants so that people can see the Fed stop raising rates, which is sort of what I think some of this is based on, is the idea that we're going to hit a point where the Fed is going to stop and then they're going to reverse.
So why do you like Amazon?
Well, my point on Amazon was just that it rallied back from what we thought was an oversold position because the concerns about the retail side of Amazon. I think Amazon's web hosting services is in good shape, but I think that stock's also rallied back very nicely, and so some of those areas I'd be a little bit cautious jumping into here.
Is there anywhere that you would sell at this point, given that we're seeing some of these sectors really give up some gains? You take a look at the NASDAQ falling to session lows just as we speak, and you wonder if people are starting to take some chips off the table again.
I think there's a rotation again, and I think that people are chasing those, some of those meme stocks and some of those retailers, and I'm not sure that that's a direction that we would be going in either. The energy stocks have come off quite a bit, and I think that there's some interesting opportunities there because I think you have a longer-term picture where energy prices are going to stay at levels that make these companies some reasonably good money, and the supply picture does not look like it's about to expand momentously in any near term. So I think there's some places where you have some value still in the market, but I'm not sure, I do think that we're back to the Fed's going to raise rates and therefore technology stocks are going to come off a little bit. And I think that tension is back in the marketplace.
So do you see gas prices going back up again?
I'm not sure that they go up in the very near term, right? You've got seasonal factors in gasoline, one of which is that summer gasoline is more expensive than winter gasoline. And you do have a bigger driving season in the summer than you do as the months cool off. But I do think that oil prices have come down quite a bit on the back of some of the issues, both on a pricing side for demand destruction in gasoline and because China isn't doing as well and you've got slowdowns globally. So I don't know that that's a permanent state, but I also think that you've got some issues going into the winter with Europe, and I'm not sure how that's going to affect the price of oil specifically, but I definitely think that the energy complex is going to struggle with what's going on in Europe.
And how does that complicate the inflation picture once again, Sarah? Because on one hand, you do have an easing right now, but even if it's not before November, the midterm season, then you still have potentially higher energy prices ahead, and therefore another inflationary pressure in the middle of a Fed hiking cycle. Does that throw everyone's predictions off into next year?
This is one of the reasons that I said, oil prices coming down, which helps the current inflation picture, isn't necessarily a permanent state. And it also doesn't mean that they're going to go right back up again. But the things that are also very sticky on the inflation front, like housing and food, that is not coming down in the same way that energy prices do. And that's a much stickier situation when they get high. So that's harder to fix. So the underlying inflation rate may stay higher than people want it to, which puts the Fed in an even trickier position of how they manage to thread that needle between we want to try to bring inflation down, but some of these prices are difficult to bring down. You've slowed down housing starts by raising rates, but in the end, that also doesn't help rental prices, right, if you're not building as many units.
Sarah, given all of that, given what we've been talking about, given the rally that we've seen in stocks, given the message that we may get from the Fed at Jackson Hole, do you think that the market is fighting the Fed right now? Why do we see such a big gap between Fed narrative and market narrative?
I think that partially the market has decided that the Fed is going to be in a situation that they would prefer, which is we're going to hit once more in September and then we're going to pause and then maybe the next move isn't higher. I'm not sure that the Fed wants that to be the message that came across, and I think that you may see some pushback in Jackson Hole. You may also see a lot of people come out and say, we still have to worry about some of these underlying factors. So I think it's going to be a really tough. The next 6 months might not be so bad because you're going to get September and then maybe we get a pause. The question is what's really going to happen in 2023. We haven't really seen an earnings recession. That's also part of what the market was baking in June. And I'm not sure that earnings are going to be able to hold up to the extent that people expect them to on the back of rising rates and some of these higher input costs.
Sarah, great to catch up as ever. Thank you very much indeed for your time. We really appreciate it. Sarah Hunt of Alpine Woods. Greatly appreciated. What are we going to do next? Liz Cheney says she has a new goal after coming up short in Wyoming's primary election yesterday. More on her future in Washington and elsewhere. That's next. This is Bloomberg.
my fallout is.
I have said since January 6th that I will do whatever it takes to ensure Donald Trump is never again anywhere near the Oval Office, and I mean it.
That was Republican Representative Liz Cheney in her concession speech, and the fact that she gave a concession speech is important. This, of course, after she lost Wyoming's GOP primary race to a challenger backed by former President Donald Trump. Let's get some insight now into what happens next. We go to Bloomberg's Washington correspondent, Anne-Marie Hordern. Anne-Marie, is Liz Cheney going to run for president?
It's a good question. She said she's still thinking about it today on the Today Show on NBC News, and that's been a lot of the chatter. And when she gave this concession speech, she also made a point to say that Abraham Lincoln did not win when he ran for the House and the Senate, but then, of course, won when he ran for the highest office. So it does look like that's potentially in her mind at the moment. She also has about $7 million left over from campaign financing. And on top of that, we learned this morning from Politico that she's going to be setting up a group and an organization, and really her main focus is to try to get, the old, what she would describe, Republican Party back, and not this obsession that many feel like they have to the former President Donald Trump. The reason why she lost is because this in Wyoming is very much so Trump country. He carried this country by 70%. So this was really a vote again for her or for the former president.
And it's not the only place where the former president's vote of confidence has mattered. What does this say, her loss say, about the state of the GOP right now and how it's going down in Washington on a day like today?
Well, it just shows still the amount of control that the former president has on the party. If you look at the number of individuals who have run for office that had his backing, by and large, they were the ones that won. I think it's about 17 that have lost when you look across international, state, federal positions that people were going for. So it just shows that if you want to make it as a Republican, you need to be very careful about who you show that allegiance to, right? Because if you want to make sure that you're going to get ahead and keep your seat, you're likely going to have to show this fealty towards the former president.
Okay, given that, why are Alaska and Wyoming different?
So two reasons. One in Alaska is that there's a logistical reason. They have a new format where a number of individuals can get through, because at the general election, you can have a number of people run and then you rank those individuals. So say your first ranking individual didn't get it, your vote would still count for your second or third. So you have Senator Murkowski. She is also a Republican who also voted to impeach President Donald Trump. She has drawn the ear of the former president as well, but she was able to make it through. So there's that. And there's also the sense that, like Liz Cheney, she also has this family ties, political ties to Alaska, but his really rebuke on Representative Cheney was particular, given the fact that not only did she vote for the impeachment, but she was now really the top Republican and the star of the select committee that was investigating the January 6th insurrection.
Really quick here, I'm really wondering, Anne-Marie, what other races are you watching? You know, you're looking at the polling data of Marco Rubio in Florida, and you wonder what's going on. Where are some big changes happening?
Yeah, it looks like, according to this latest polling data, that he is potentially behind. Yeah, House Rep Val Demings has a 4% lead. What is interesting is that there was this narrative that there was going to be a huge blowback, a really sweep of red across the map going into the midterm elections. The calculus might have changed now that we were at nearly the end of the summer, given the summer the Democrats had. One of their biggest issues was inflation and gasoline prices. Right now, gasoline prices are coming down, and they've had a number of legislative wins.
Anne-Marie, we have to leave it there. That's Bloomberg's Anne-Marie Hordern. Always keeping an eye out for us. Coming up, a massive profit miss from Target, in stark contrast to Walmart. We'll break it all down with the Telsey Advisory Group Senior Managing Director and Assistant Director of Research. This is Bloomberg.
the U.S. economy right now is in a stronger and a more resilient place than any other major economy globally to actually navigate the global challenges that we face, which include potential growth slowdown in China, which also include the impact of the war in Ukraine.
That was National Economic Council Director Brian Deese, and we're an hour now into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves.
Well, Shonali, we certainly have some losses on our hands on the day. The S&P 500 down about 0.75%. The NASDAQ down even more, down 1.2%. And take a look at the stocks. That chip index down 2.8%. So clearly there's some pressure. This is the worst day in about 3 weeks. And relative to the stocks, B of A has interesting comments out on NVIDIA saying that last week's bearish pre-announcement was helpful, but they could do another cut and that would help even more. So investors seem to not like that. But the overall pressure on markets right now does appear to be rising yields, that 2-year yield backing up about 8 basis points on the day. In fact, let's take a look at a terminal chart that really shows us the difference between value and growth. So what we're looking at here in yellow is the 10-year yield. In blue, we're looking at the Russell 1000 value index relative to the growth index. So of course, when it climbs, that means that value is outperforming. So as yields have backed up, that has really pressured the growth stocks, the tech stocks. Now, the recent rally, this has happened as yields have come in to some degree, that's helped investors, traders get more involved in the growth stocks, less with the value. But it's interesting to see as we have yields backing up a little bit more, that is doing what it's done in the past, pressuring value, or excuse me, pressuring growth as is happening today, and perhaps letting value happen a little bit more. Something interesting though, when I was digging into that value index, Bed Bath & Beyond was in there. I'm not sure how that works out. So don't take it all that, when you dig down, it can be interesting. Target down almost 3%, a messy quarter there. They missed. They really are slashing prices to move inventory through. The CEO, Brian Cornell, is talking about a rebound ahead, but investors not excited about this, especially given the fact that Walmart beat their lowered estimates. That stock up higher today. TJ Maxx turning around. Earlier it had been lower, a messy quarter there, and also the view really not being held, given the fact that the treasure hunt, which has been so strong in these tough times, not as much now. And Lowe's holding nice gains, up 2.1%, a very solid quarter there. Now, we were talking about rising yields, Guy. If we take a look at a chart of the 2-year yield, we're going to see, and this almost feels stealth in some ways, but over the last several days, we have the 2-year yield creeping back toward 3.35%, and this suggests maybe that some traders, it really, relative to the September meeting, creates that debate between will they hike by 50 basis points or 75 basis points. This action, I would suggest, Guy, who knows? We'll find out in September.
We might find out before then. Jackson Hole upcoming. Abigail, it's going to be fascinating to hear how Powell pushes back. Abigail, thank you very much indeed. As Abigail's been talking, we've seen U.S. crude snapping higher. We've seen the EIA data coming out. In terms of the draw, the median estimates was for a build in terms of crude. We got a big draw. We've also seen U.S. crude exports rising to a record. This is basically as Europe replaces Russian oil. We're seeing the U.S. stepping in and filling some of that void. So oil snapping higher. You can see what's happening with TI and Brent both up, but WTI up the most. We've also seen within the last couple of minutes Goldman Sachs cutting its China 2022 GDP forecast to 3% from 3.3, which is going to weigh, you would have thought, on the oil price. But let's get back to the retailers, figure out what's happening there. Abigail was talking about what's happening with Target. Interesting compare and contrast with what is happening at Walmart. Target's profit badly lagging behind Wall Street's estimates in the latest quarter, but the retailer sounding pretty upbeat about the rest of the year, forecasting a dramatic rebound for the second half and talking about the fact that the inventory pain largely is now in the rearview mirror. Joining us now to discuss, Joseph Feldman, Telsey Advisory Group Senior Managing Director and Assistant Director of Research. He has a 185 price target and an outperform rating on the stock. Joe, what did you make of the numbers? The headlines look pretty disappointing.
Yeah, the headline was definitely disappointing. We were surprised that profit was as bad as it was. I mean, the company worked really hard to clear through inventory. And on the surface, when you see the 36% increase in inventory year over year, it doesn't look like they made much headway. However, if you keep digging underneath, you will find that they cleared through a lot of discretionary items, and they're clamping down on orders of discretionary items for this back half of the year. So they're really focused on getting better in stocks in essential goods. and they're seeing traffic into the stores to buy those essential goods. So, we're hopeful that things will look a lot better in the second half, but it was definitely a disappointing quarter. And actually, the third quarter is probably going to have to come down a little bit relative to current expectations.
Current expectations. I love this Bloomberg Terminal headline. Target is betting its reputation on the second half. And so if you think about the second half of the year, how much downside risk is left?
Well, it definitely needs to see second half numbers come down a bit. Third quarter, I think, is going to be down. The Street's currently forecasting around an operating profit of around 6% relative to sales. And they're saying it should be a bit lower than that. Fourth quarter, however, should rebound and be back to a more normalized level, closer to like 6.5%, 7%. So if that's the case, we may see a little bit of erosion, but things should start to get better. There's still a lot of inventory that has to move through. Consumer definitely seems to be a bit weaker based on what we've heard from Walmart and Target. We're going to see more promotions necessary to clear through goods. So you're going to see continued pressure on profits. But I think you're right. At this point, Target really does have to see some improving trends in their profit side of things, just operating better than they've currently forecast.
So execution needs to improve, but I imagine the crystal ball is fairly difficult for these companies as well to be able to navigate, and it looks pretty opaque right now. Joe, how much of this is down to what happens with gas prices? How important is that in the second half of the year? They've come down 5.43. If they go back up to 5, what does the picture look like in the second half?
Yeah, I think that's a great point, Guy, because you really do have to see gas prices kind of stay down here. It really, as gas prices have come down through the quarter, we've actually seen most retailers talk about sales getting a little bit better as the quarter progressed, and then into July and now into August, sales have picked up a little bit. So there is definitely that correlation for the consumer. We'd like to see food prices come down as well. Food prices are currently trading at around 13% increases year over year. And that keeps accelerating. It was 11% in June and 12 and then now 13. So if that can roll over and see peak, that could be a benefit as well. But listen, we heard from Walmart and Target that consumer has been trading down and focused on food and basic items, and really they need to see a little bit of relief on other parts of their spending.
Yeah, relief. And, you look at all the companies in your universe here. We have a lot more information today than we had yesterday. Who is going to win out when you look at 2023, the new consumer and this new inflationary environment? What behaviors stick?
Yeah, well, we still think that the discounters and the grocers are very well positioned for the current environment. I think Costco is a big winner in all of this, because if you think about Costco, cater to a more affluent consumer. The affluent consumer is looking to save money as well. And so, they do a really good job, especially on basics, food, and things like that. We like Walmart. We like the dollar stores. I think that they're set up pretty well. Actually, Target, the stock price is pretty inexpensive relative to where it's traded historically. And if we can now come up with a new baseline here after today's earnings and look out to 2023 and hopefully see some improvement, that might look a lot better next year from a stock perspective. So I think that end of the market's pretty good. Home improvement's been holding better than people think as well.
That's exactly where I was going to go, Joe. What do you see housing holding up? What are you seeing in the housing trends? What do you see in home improvement?
So I think it's really important from a home improvement perspective to think about the drivers of that business, which are home price appreciation, aging housing stock, employment levels, people making money, disposable income. Those are different than the broader housing market. So housing turnover, that impacts the builders. So the drivers of home improvement are actually fairly solid for Home Depot and Lowe's to continue to perform fairly well in this environment. Mm-hmm. Pro customer backlogs are pretty high. We'd like to see the DIY customer, the do-it-yourselfer, get a little bit stronger. That was a pressure point at Lowe's this morning. But if that can come in a little bit better, we could see relatively decent trends for the home improvement space going forward.
We'll keep an eye out. Thank you. Joseph Fellman, Telsey Advisory Group Senior Managing Director and Assistant Director of Research. And coming up, we have Bed Bath & Beyond surging as the meme stock frenzy returns. Jamie Rogozinski, Wall Street Bets founder, joins us next for an exclusive interview. This is Bloomberg.
Keeping you up to date with news. Keeping you up to date with news from around the world. Here's a first word. I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky warned civilians to stay away from military facilities occupied by Russian forces. That followed explosions at a Russian ammo dump in Crimea. A Zelensky advisor said the blast marked the beginning of a series of attacks. Last week, explosions at a Russian airbase in Crimea destroyed fighter jets. Inflation in the UK jumped more than expected last month to the highest level in 40 years. The Consumer Price Index rose 10.1% in July from a year ago, following a 9.4% gain in June. Now, that will put pressure on the British government and the Bank of England to take action. Goldman Sachs said that a deal to revive the nuclear agreement between Iran, the EU, and the U.S. is unlikely to be reached in the near term. The firm predicted that even if there is a breakthrough, additional oil from Iran won't start to flow till next year. The U.S. is looking at Iran's response to a draft proposal of an agreement. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Shonali.
Lisa, thank you so much. We're going to talk now about Bed Bath & Beyond because shares are absolutely rip-roaring for a sixth straight day. The home goods company has helped reinvigorate a wave of meme stock buying. And joining us now is the perfect person to talk about this. That's Jamie Rogozinski. He is the founder of Wall Street Bets. Jamie, are you surprised at all? Because there was a little bit of a lull here in day trading. We're also, facing a lot of troubles when it comes to people's pocketbooks with this inflation. So are you surprised to see so much trading come back?
I'm not really. It's summer vacation's over. Everyone's back in school at this point, so that's when the activity gets to kick back up. The momentum that we saw with the retail trading back in January 2021 has kind of whimpered down a little bit, but it goes in cycles, just like the regular economy. There's no way that we can keep momentum going the way that is required in order to make these types of moves. So not surprised. I was kind of expecting at some point or another that we'd see something. I didn't expect to see the exact same replica of what we saw last time, though.
Jamie, are the drivers different or the same?
The drivers appear to be the same, right? Like we're still kind of early on into this. It's just been going on for a few days, but we have the meme component. Everyone's talking about it, the chatter, the enthusiasm. You have a stock that is from a company that's relatively distressed. You have a high short float. You have Ryan Cohen dipping his hands into this particular stock and giving his Midas touch to it. So it's got a lot of the same components to it.
Is Ryan Cohen like the king of the memes here, or are there other people that traders are looking out for to really follow into the fray when it comes to making new bets?
I was tempted to tweet something to that effect last night because Ryan Cohen really is becoming that. Look, there's no one individual. I think that if high-profile individuals decide to get into a stock or just add to the overall thesis to find some confirmation bias, then it's always helpful. It can be him or it can be, Elon Musk, which is popular with doing shenanigans. We have all sorts of different quirky public figures or CEOs or otherwise that have influence in the stock market. So it's hard to pinpoint. The thing about retail trading or Wall Street Bets is that it's a collective, right? Like there's no captain of the ship saying this is where we're sailing. The power comes from the numbers. The power comes from the fact that there's collective decisions that are made. So there's no individual that makes that choice.
Jamie, you say that we're kind of only a few days into it, which clearly we are, but it's happening pretty fast. Has it got legs? What's the sustainability story?
As long as we don't hit the pause button, the disable the buy button, I think that we probably have some decent chance to keep going forward. Look, it's impossible to tell, right? I was asked recently as to whether or not I'm buying it, and I'm not because I don't believe in it. It's because in order to be profitable, you need to have a strategy around these very volatile moments, and I personally don't have one yet. Doesn't mean that other people haven't figured it out. That said, I have no idea. This thing could keep going up and up. I keep seeing numbers about price targets being in the 60s, and knowing the people on Wall Street Bets are probably aiming for the moon.
to the moon. You know, I'm kind of curious here about how much of this is a lot more about the feeling behind it, you know, the fighting against the institution, Jamie, because some of this was a frustration with people who were going short before, but some of those same funds are not behaving in the same way now. They're not shorting as aggressively. Some of this was born out of frustration for firms like Citadel Securities. Does that sort of thing still exist, or has some of that abated?
I'm sure that still exists, but like I said towards the beginning of the segment, I'm surprised that this is able to be replicated, right? Like when asked previously as to what the next GameStop is going to be, my answer was the market is wise. They will adapt. They will not short as much, and they're definitely not going to go on a roadshow when they do decide to short sell. And they've gone secretly short selling, et cetera. But I'm surprised that they haven't put the mechanisms in place, not they meaning regulators, they meaning the other market participants like stock options market makers, to increase the implied volatility, make it more expensive to basically do these maneuvers. So I am surprised that they're allowing the same thing to happen, but it is actually happening, even if these institutions are now shifted their approach a little bit.
Jamie, does it matter if the backdrop is different? The Fed is tightening. You've got people talking about and worrying about a recession. Inflation is a theme. People are talking about and have seen recently a bear market. We've clearly bounced off our June lows. Does the backdrop... Previously, there was logic to the backdrop. There were a lot of people at home. They had the objective of going out there and maybe having some fun as well as making some investments. This time round, the backdrop feels different. So if you overlay that different backdrop, what does that tell us about the sustainability story here again? I'm really curious. People are, as you say, the end of the summer's here. People are back making these sort of trades. But are we just going to have a series of waves of these kinds of trades that are almost completely divorced from the fundamentals that are happening in the economy?
Yeah, I mean, I was going to say the only thing you're missing is the discounted cash flow analysis for these stocks. No, that you said it right towards the end. It's the fundamentals. Like when you go into your broker, it's like, do you think the stock price is going to go up or do you think it's going to go down? It's buying and selling. It's supply and demand. That's the number that we get to see as far as the price is concerned. And for the people whose stock options are expiring on Friday, no, it's irrelevant, right? Like it's these like short-term moves. I do believe that towards the very, very big picture, there's a price discovery and market efficiency and all sorts of things that do adhere to fundamentals a little bit more. But the people that are into meme stocks, just like memes come and go quickly, same thing goes with these prices. They could potentially sustain. GameStop is still not sustainable at the price that it's at if you use fundamental analysis. So who's to tell? At this point, supply and demand, you also have activist investors that can decide if we want to have it be this price, and we will hold it here until it's worth that price, right? So,
right. Jamie, you know, speaking of pricing, you take a look at something like the Roundhill Meme ETF, and that tracks a bunch of popular meme stocks, if you will, but it's not rising like you're seeing this really big group of traders surround around Bed Bath & Beyond. I'm so curious as to what you're seeing as the next big trades for this group.
Yeah, shout out to Willa Hershing. He's actually a big fan of Wall Street Bets. Look, I've always had a criticism towards meme ETFs, at least the way that they're currently structured because of certain regulatory constraints that exist. And I'm not super enthusiastic about the concept. Why? Because a meme stock comes and it goes and it's quick. An ETF has to like restructure, rebalance, file for changes, add a thing to it by which time the meme stock is over. So I think the concept behind these ETFs is good, but the execution isn't. And as you just pointed out, I doubt Bed Bath & Beyond has the proper weighting on it within that one or any of the other ones. I know that Dave Portnoy's got one called, I forget, but you know, there's a lot of people trying to go for that, and the execution is just not quite there on the mechanics.
Jamie, why am I not seeing the same thing in crypto? Bitcoin's up off its lows, but not much.
I want to know why Bitcoin wasn't up when inflation's going through the roof, right? I don't know the answers to that. I can say that it's also supply and demand, but you'd also think that the enthusiasm behind retail traders, which tend to also gravitate heavily towards crypto, would be doing that as well. I don't know the answer to that, and I would love to.
Yeah. You and me both. Jamie, great to catch up. Really appreciate the time. Thank you very much indeed. Jamie Rogozinski joining us, Wall Street Bets founder. Thank you very much indeed, sir. This is Bloomberg. European markets coming into the end of the day. Let's take a look at what the price action looks like. Stock 600 down by around 0.9% at the moment, just a little more, down nearly 1%. If you take a look at the composition of the sectors, it's fascinating. The only two sectors that are higher today are food and energy, the two things that basically we are worrying about when it comes to the inflation story here in Europe. Speaking of which, take a look at what's happening with the UK 2-year. We are up by 25 basis points. Gilts are selling off pretty aggressively, 2s and 10s. We've got inflation at a 40-year high here in the UK. It's in double digits. And yes, where is the problem? Food and energy. Back to the stock market. Nat gas actually going sideways at the moment, but the energy story is continuing to get really interesting. You've just seen that data coming out from the EIA talking about the fact that the US is replacing a lot of crude that was previously coming from Russia. That's going to be interesting as we work our way through into winter, because you're going to see this energy switch, gas to liquid fuels. That story is going to be amazing to watch. We're going to talk about all of this next. Carsten Bretsky is going to join us, ING Germany's chief economist. That conversation is next. This is Bloomberg.